Why does the central bank create a lost window for banks? Because liquidity is like oxygen in banking. It is invisible when present, catastrophic when absent. When interbank markets freeze or sudden outflows hit, banks need immediate funds. To prevent panic, the Reserve Bank of India created the Liquidity Adjustment Facility in 2000. Within it, the Marginal Standing Facility, introduced in 2011, acts as an emergency borrowing window. But this safety net is not unlimited. It has a cap linked to net demand and time liabilities. That cap matters. Under the Liquidity Adjustment Facility framework of the Reserve Bank of India, banks can borrow short-term funds through two primary routes: repo and the Marginal Standing Facility. The maximum amount a bank can borrow under the Marginal Standing Facility is up to 2% of its net demand and time liabilities. Net demand and time liabilities represents the total deposits and other liabilities of a bank that are payable on demand or after a fixed period. It forms the base for calculating statutory requirements like cash reserve ratio and statutory liquidity ratio. Linking marginal standing facility borrowing to net demand and time liabilities ensures that emergency liquidity is proportionate to the bank size. The marginal standing facility was introduced in 2011 as a crisis time instrument. During the global financial turbulence and episodes of domestic liquidity stress, banks sometimes faced overnight fund shortages. The regular repo window might not always suffice. Marginal standing facility allows banks to borrow overnight funds by pledging government securities, even dipping into the securities maintained for SLR up to a permitted limit. The interest rate under marginal standing facility is higher than the repo rate. It usually forms the upper bound of the interest rate corridor under liquidity adjustment facility. This design discourages routine usage and ensures that banks approach it only during genuine stress. Think of marginal standing facility as a penalty box, accessible but expensive. For example, if a bank has a net demand and time liability of 5 lakh crore rupees, it can borrow a minimum of 2% of that amount, which equals to 10,000 crores under the marginal standing facility. This ceiling prevents over-dependence on central bank liquidity and maintains market discipline. The 2% cap serves three policy purposes. First, it prevents moral hazard. Banks cannot rely indefinitely on central bank funds. Second, it maintains systemic liquidity stability by limiting excessive expansion. Third, it strengthens the interest rate transmission mechanism by anchoring short-term rates within the LAF corridor. In essence, marginal standing facility is not meant to finance growth or structural deficits. It is a safety valve against short-term liquidity shock. By restricting borrowing to 2% of the net demand and time liabilities, the RBI balances flexibility with discipline, providing oxygen but not unlimited air.